Hello and good morning, listeners. This is Almus Market Mornings with Jayaram Krishnamurthy, rounding up the latest set of global financial updates. Now, folks, we have had the Australian inflation data released moments ago, which turns out to be at 4% higher than the expected 3.8% on the YOY basis. Now, this reinforces the idea of being vigilant, as mentioned by the Assistant Governor of the Australian Central Bank. And this is also one of the concerns by a lot of global central banks. So that's one bit of data release that we have received just today. Quite interestingly, there is also a set of market participants expecting as high as 2.5 to 3% of rate cuts by the Fed in the next 9 to 12 months. DK, I'd like your take on this. But meanwhile, the currencies have continued to trade in the narrow range. And on the contrary, we see the Nifty 50, or our domestic equity benchmark index, making a new high yesterday. So, JK, what's your take on all these set of updates?
Yeah, good morning. Yes, the Australian data confirms the fact that inflation remains sticky and it's not, you know, sliding as fast as the central bankers or the governments would wish it to be. A lot of liquidity in the system and the asset market performance, all these creating some sort of wealth effect, and the demand is sustaining. That's the reason why the inflation is not going away. Secondly, on the broader, bigger bond market expectation about the rate cuts in US, magnitude of 3% rate cut, all that is only possible if we see a sharp recessionary situation in the US. Without that, I don't think we will be able to see that kind of thing. Yes, these things have happened in the past. And big players do position for such things. But as of now, at least the US economy is not doing so badly, and inflation stays at somewhat more stickier levels. So difficult to see such things happening in the near future. And also, if you look at the data that was data calendar, it has been quite light on Monday and Tuesday, except that we had the consumer confidence number in the US that actually slipped somewhat, compared to last month. And historically, the levels at which we are in the last few months, some analysts says that this is the average is below the level where US slipped into recession historically. But again, the radar is that there have been many parameters, including the yield curve inversion, which have not worked as far as predicting a recession in the US is concerned. Therefore, I would take that with some reservations. But yes, consumer confidence is a forward-looking indicator. It is showing that economy may be slowing down further. That's all I would derive from it. Data calendar is light again today, but it thickens from tomorrow with GDP number. It will be interesting to see the number after it has been sharply revised to 1.3% in Q1 of 2024 from 3.4% seen in Q4 of 2023. And then, of course, the PCE core inflation number, which the Fed looks at very closely for their monetary policy assessment, is likely to slip, on the month-on-month basis as well as on the year-on-year basis. We see slippage across all parameters. For instance, the month-on-month number on the headline is expected to slip to 0.1% from 0.3% previous month. And the core PCE month-on-month is also expected to be at 0.1% from 0.2%. Of course, this kind of number, is probably discounted by the market, but any softer number than that could be helpful in goading Fed into getting more dovish than they have been. So far, they have been very guarded in their expectation of rate cuts. in the year, of course. On coming more to specifically to the dollar, it has been testing its resistance, and factors are not really turned in favor of weakness in the dollar, because French election uncertainty continues. It looks like no one is going to get a clear majority, but then post-poll situation or the picture that will emerge is what will be important. So the uncertainty remains till maybe middle of next month as well. That keeps the euro somewhat underperforming. Japanese, then, apart from verbal statements, Japanese have not really acted, and the view is also emerging that a mere intervention like they did a couple of months back is not going to work, because the market has been emboldened by the failure of past intervention. So unless it is combined with some other announcement, or if they involve other central banks, that can send a slightly stronger message to the market not to speculate too much on yen weakness. On the Chinese side, again, we had new high fixing for the daily rate of the Chinese central bank. The onshore and the offshore yuan have again weakened today, and this is ongoing thing, and this is also going in line with the yen movement. So overall dollar is well supported. What stands out amidst all this is the rupee, supported by macro factors, domestic macros, external macro also improved. Current account data was showing a surplus for Q1. We have bond inflows expected. There is a market talk about one chunky inflow of 2 billion that is expected on Friday. We'll have to wait and see whether RBI will absorb those flows at these levels, or will they allow it to slip and buy it at a lower level. Definitely they are not going to let rupee to strengthen too much, but just a matter of whether they will be buying at 83.40 or 83.25. So that's the thing. But of course, if the US inflation number also comes weaker, along with the overall dollar weakness, the rupee should also gain somewhat. That is the expectation. So a lot to look forward to, although it has been quite a quiet period for the first half of the week. Thank you.
That's quite good, JK. And yes, folks, if we have to talk about USD INR, INR has been holding the fort for a while with the central bank presence, as well as the good set of macros that are working in the favor for the time being. A chunky flow, as JK mentioned, is also under expectation, while there have been some sort of good flow management going on. But having said that, if we have to talk on macros more, there's a very interesting session which we are conducting tomorrow. Along with the market experts, we are calling portfolio manager and fixed income investments head of DSP Mutual Fund. Both are the stalwarts and experts in their field, and they'll be sharing more on the Indian macros and the Indian markets. So it's going to be quite a cracking session for you to join in. And I'd personally like to invite you all to have a presence over there in the session. But having said that, to conclude today's episode, we shall say that inflation continues to remain sticky, as we've seen with the Australian economy. But even though the market participants are anticipating or taking positions with respect to major rate cut, it is a need of a sharp recessionary setup for this kind of rate action to be seen in the market. So it all goes, how do we see the market um, or the economic data releases coming in the days ahead, or any which ways. We have already seen the consumer confidence slip a little, and as JK mentioned, these are forward indicators, but barely any indicators have been working when it comes to predicting a recession in this particular phase. So that's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for joining in.